Welcome back everyone. Today we will talk about how derivatives are used. In short, we will begin to move from theory to practice. Let's say that the financial derivatives market, which refer to stocks, bonds or indices, is very different from the real assets derivatives market, such as commodities, oil, wheat, etc. A derivative contract, written on a financial asset, is almost never used with the intent of concluding the transaction with the physical delivery of the underlying asset. In reality, in fact, only 3% of contracts are completed. The purpose of a long position in a financial derivative contract is to profit from the sale of the derivative itself after a movement of the underlying price, which is replicated in the derivative. We buy a future because we want the market to go up, we wait for the movement, and if this happens we sell the future and make money. Or, we sell the future short because we want the market to go down, and after the drop, we buy back the position, and we close it and make money. These operations are made for hedging or speculative purposes. Why use derivatives, futures and options, instead of the underlying asset? Because we benefit from an important advantage over the direct purchase. This advantage is summed up simply in the amount of capital that is required. Those who operate in the financial markets and use derivatives are allowed not invest the total value of the underlying asset, but they can invest only a part of it as a collateral, which normally corresponds to about 11%. This security deposit is called the margin in jargon. Using only the 11% margin frees up the other 89% of capital. We place a deposit, and we are allowed to enjoy gains or losses of the same amount as those who own the entire value of the underlying asset. This characteristic is the so-called leverage effect. The leverage effect is one of the main characteristics of a derivative contract. The leverage is a double-edged sword. It frees up a lot of capital, but it is particularly dangerous if its mechanisms are not perfectly understood. We must not forget that with derivatives, we are trading underlying assets that are worth much, much more. Let's take a real example on a future known by most of the operators, S&P 500. The S&P 500 is a stock index that replicates the 500 most capitalized American stocks. It is among the most traded indexes in the world. Within it, you can find other sectoral indices, such as technology, materials, industrials, consumer staples, and so on. The future on S&P 500 is traded at the Chicago Mercantile Exchange since 1982, and one can trade also options. These derivatives allow us to operate on the S&P 500 index without owning all the stocks that make it up. The price of the future contract replicates the value of the index, which in turn depends on the weighted average price of its 500 stocks. Futures and options therefore closely follow the price movements of the index in a direct and proportional relationship, both rising and falling in the same way and with equal intensity. To trade the future and the options, it is necessary to have two. First, a particular trading account with derivatives trading permission. Second, a minimum amount of cash to make the deposit and some free cash for the fluctuation of price that is booked in our account on a daily basis. So, trading derivatives is possible if you have enough cash for initial and a maintenance margin. The S&P 500 future contract is worth $250 per point. If by hypothesis the future beats 3,000 points, it means that this contract is worth $253,000, that is $750,000. Moreover, CME issued in 1997 the E-mini S&P 500, where each point is worth $50, so the whole mini contract is worth $150,000. In both cases, we do not need such a big amount of money to trade this basket of American stocks. Your broker may ask you to deposit approximately 10 to 11% of the whole, so $15,000. From here you can perfectly understand the leverage effect of the future. With an initial deposit of only $15,000, we can manage a contract that is worth $150,000. It is essential to point out that the simple deposit of a margin does not represent our maximum loss. If by hypothesis the underlying price dropped by 20% and goes from 3,000 to 2,400, our portfolio would lose 600 points, which, multiplied by $50 per point, are $30,000. Let's put it in a chart. Putting $15,000 in margin inside the pot allows us to control $150,000, and this is in fact what happens to the position. The margin is used just to guarantee the opening and maintenance of the position, but our profit or loss may be well above the amount of the deposit. The risks and opportunities of the derivatives is inherent in their financial leverage. The leverage tends to amplify both profits and losses and often creates huge problems in the portfolios of newbies. It is important to remember that the whole contract is not the guarantee margin, but the real worth of the underlying, which, in the case of E-mini SP 500, is not $15,000 but $150,000, which represents the total value of the underlying asset. The SP 500 future is regulated by the CME Globex. As for other financial instruments, people who want to trade the future have to deal with the so-called trading book, where they see the proposals of those who want to sell, the ask, and of those who want to buy, the bid. The difference or distance in price between buyers, bid, and sellers, ask, is called spread. The spread can increase or decrease depending on the market conditions and its volatility. The main figure who guarantees liquidity and a tolerable width of the spread is the market maker. The future expires quarterly: March, June, September and December. The options on SP 500 have weekly or monthly expiration dates, and we can enjoy many of them. Generally, the largest trades take place on the closest monthly and quarterly expiration dates. In the case of SP 500, on the third Friday of the expiration month, all positions are closed automatically and settled in cash. In our portfolio we will not have the stocks tracked by the future, but only a cash regulation, calculated according to the price of the future itself. In any case, the trader who wants to maintain the position for the next quarter can simply proceed with the rollover as the expiration approaches. The rollover is not rocket science. The trader closes the contract that is about to expire and opens a new contract on the next expiration date. At this point, we have discovered many things that allow us to understand both the risks and the opportunities of trading financial derivatives. The leverage effect that enhances the profits but also the losses. The capability with a relatively small amount of cash to control a huge contract that normally would require much more capital. Thanks for your attention. See you in the next video.